Well, good morning, everyone. Thomas Montgomery. It's great to be with you. Today is Tuesday, August 26th, 2025. We get together most weekday mornings. Granted, we didn't yesterday, but most weekday mornings we get together at 8 o'clock Central. And my screen should be shared with you here. So our organization is 509 South Pacific. Our website actually is on in the background, 509pacific.org. If you need support or assistance, we recommend first texting 903-347-8042, our office number that's answered live, as long as one of the staff's available is on the bottom of the website. In terms of our nonprofit, we've applied for and received a grant. There are 3 mandates, in other words, 3 things that we're supposed to be doing that we're actually held accountable for, the first of which is increasing financial literacy. The bottom line is there's a lot of people out there that want money and need money to start or grow a business, but many of them don't know what you and I know. They don't know that there's a formula for funding. And so these morning Zooms are part of that, but also we're looking for those of you that want to go out and educate in your community to build financial literacy. One of the great topics that you could teach is called the 27 mistakes. And that is about an hour-long curriculum. You could teach it live or play the on-demand, but it goes through what typically keeps entrepreneurs from getting business funding, and then conversely talks about how we can help them. Our second mandate is we give away free Shelf Corps. Well, why would we do that? Well, if a business owner is wanting business funding, then we need to have a fundable business. We need to have that infrastructure to get approved. And a lot of small businesses lack that. So instead of fixing what they have, it's easier for us to provide them just a nice, clean Shelf Corp that is ready to move forward. And through the grant, those are free. Our distribution partners can add a processing fee, so they're able to monetize that. We have some of you that are charging a couple hundred. One of our top producers this month, she charges $5,000 for the processing fee for the free Shelf Corp. So that, almost all that's going into her pocket. And she sold over 20 this month in August. So just on the front end, she has generated over $100,000 of income for herself. And then ultimately our goal is with the improved financial literacy and the fundable business to help entrepreneurs get the money to start or grow. And through our program, we guarantee funding, which is hard to find, right? Because that is putting the risk on us. We guarantee a minimum of 100,000, but typically most of our clients are looking for $1 million plus. So that's just the background of who we are. Today's agenda, we've I guess we've not done this. So on 509pacific.org, there's the quick cash, which is not our topic today. There's our business funding resources, which is tied to what we're going to discuss today. And then towards the bottom is being a distribution partner. So there's really 3 sections: quick cash, business funding, distribution partner. So that's good enough. If you want to go to 509 Pacific, you can learn more. Our topic today is a really, really important one, probably one of the most important topics that we could discuss. We're going to kind of compare and contrast what I believe are the 2 primary sources of funding for small businesses: SBA and ABL. We'll get into what those mean, those acronyms, and dig in, and then Q&A. So anytime if you have any questions, comments, concerns, you can type it into the Q&A. Selena's asking about the link for the 27 mistakes. It is on our YouTube channel, and I can make that available for everyone. But if you go to our YouTube channel, you'll see all of our past trainings. Once you're on our channel, you can type in 27 mistakes, it'll pop up. But I'll get that link out for everyone. All right, so let's dig into our topic today, because this is really important. If you and I were going to take a trip this weekend, we need to decide, where are we going? Are we going to Miami? Are we going to Boston? Are we going to Seattle? Where are we going? Well, in terms of business funding, we need to know what the end goal is, not just the dollar amount, but where do we want to get the funding for that client? Because based upon where the funding comes from, in other words, its source, then that's going to determine what criteria we need to meet to get approved, because there's different criteria, different underwriting for different types of funding. And that's crucial, because a lot of people, going back to financial literacy, a lot of people just say, well, I can't get funding. Well, what does that mean? You can't get what type of funding, and what is it that you're coming up short on? So we're going to dissect, take a pretty deep dive into the two primary sources of funding. And this is something that we work with each client once they're in phase two. So there's two phases to our program. Phase one is getting them that free Shelf Corp. That's from about 7 days. Then we should be able to immediately go in, get their first access to capital or their working capital. And then at that point, we're in phase two. We will identify their uses of funds. And the uses of funds is essentially like a shopping list. What is it you want money for? And if we add all those uses up, that gives us a total amount. And that tells us the size of the capital raise. So at the beginning of phase two, we're doing that. And then this topic, frankly, comes up. So this is very relevant. This isn't just a theoretical discussion. This is a conversation that we need to have with every client going through the program. Now, the Shelf Corp is the Shelf Corp. So we'll call that phase one. Phase one is phase one. There's no variance. But where we plan to go for funding for phase two makes a big difference of what paperwork, what preparation we need to put together to legally and ethically qualify. Hopefully that makes sense. So I think a lot of people have heard of SBA loans. Now, the truth is the SBA is not the lender. The SBA is the guarantor. So to get an SBA loan, you really don't go to the SBA. You're going to go through one of the SBA authorized lenders. There's well over 1,000 of those. Banks, some, not all banks, but some banks, credit unions, alternative lenders. And so we can facilitate that. Myself and Mark and Chuck, all of us that founded our nonprofit, we all used to work at the SBA, so we're familiar with that. And that's what a lot of people are thinking. But I'm here to suggest today that the SBA loan probably is not, it's not the right fit for most small businesses. They'll make the decision. We'll do whatever they want, but we'll talk about why it might not be the right choice, even though that's what they're often familiar with. And then we're going to compare that to asset-based lending, ABL for short. We've had a number of trainings on asset-based lending, and that is on our YouTube. Those are on our YouTube channel, just like the 27 mistakes that Selena was asking about. So let's go ahead without any further ado. And let's talk about some key differences between SBA loans and ABL loans. So the first of which, let's talk about underwriting. So underwriting is referring to what does it take to get approved? Well, the SBA underwrite. So the truth with SBA loans, so we've already determined that the SBA is not the lender, they're the guarantor. So the truth is, in general, for SBA loans, you have to get approved twice. So there's going to be the underwriting of the institution, let's just say of the bank, plus the SBA underwriting. So that in itself lets you know it's probably more complicated than what you might have thought. What happens is different banks or SBA lenders, we'll say, different SBA lenders can have their own underwriting. Now, they can't change the SBA underwriting, but we're talking about two. So let's say, so we have the lender and SBA. So the SBA has standard operating protocols, SOPs. Those are firm and I think congressionally approved even. So these don't change. But the lender criteria can change tremendously. And this is where a lot of confusion comes in. So when we get back to financial literacy, a lot of people will say, well, startups can't get approved for an SBA loan. Well, that's not true. And then they'll say, well, that's what I was told. Well, they might have been told that, but that wasn't because it was an SBA rule. That was specific to the individual lender. So we have to be aware of the underwriting complexity. In addition to the 2 times of underwriting at the lender and the SBA levels, typically SBA loans are looking at a broader set of criteria. What we've often talked about in prior trainings are the 3 C's: credit, collateral, capacity. So SBA loans, just simply put, look at all 3 C's. So there's just a lot more underwriting going on. In contrast, an ABL is simplified underwriting based primarily on 1 C. And to no surprise, that is the collateral. So just this, understanding this alone is very informative. So as we're working with clients to determine where should we get the funding, either are fine. Not to say that everyone qualifies for the SBA or everyone qualifies for the ABL, but in terms of what's needed to qualify, there's a much bigger hurdle to jump on SBA than there is ABL. So that's the first of the differences we wanted to compare and contrast. Any questions on underwriting before we go to the next difference? Just type it into the Q&A. I think we're good. Okay. If you have any comments, questions, concerns, type it into the Q&A. It's like a chat box. All right, owner contribution. Now, this is never popular. People get mad at us when we educate on this, but this isn't like our rule. We're educating, and a lot of people need you and I to go out and educate them. So in terms of owner contribution, there is normally a minimum of 10% owner contribution for SBA loans. So what does that mean? So if a client wants a $100,000 SBA loan, normally they would have to have at least $10,000 of their own owner contribution. If they wanted $1 million, they'd have to have at least 100,000. Now, I hear from pessimists all the time, and pessimists will say unreasonable things like, well, if I had 10%, I wouldn't even need funding. Well, that's probably not true, because you could have 10%, not the other 90%. But this is just a rule, and this is a rule that comes at the SBA levels. We're talking about 2 underwriting. Individual lenders could charge anywhere from 10 to 30%. So a lot of people were not aware of that. Now, can we go out and raise this 10%? Sure. So it's not that a client's out of luck if they come to the table and they don't have it. That doesn't mean that we can't facilitate that through a number of different means, but it is important you understand that, because it's a rule. Now, when we get to ABL, there is normally no owner contribution requirements. So we've talked about underwriting, significant difference in complexity or thoroughness of underwriting. This is a pretty big deal, because I know a lot of you are big hitters, but not everyone has the liquidity that B has, or that Amanda has, or that Corinthian has, Debbie has. So not everyone has this 10%. So what does that mean? We either need to fix that problem, which we're happy to do, so they do have it, or we need to pivot to a different type of funding. Now, I see that Denver's asking a question. Yeah, so these aren't the only 2 categories, but these are the 2 most significant. So that's why we're doing these comparisons. But Denver's right. There are other options other than just SBA and ABL, but these are the main ones for larger loans. Okay, any questions on the owner contribution? Any questions there? Okay. So let's go to restricted uses. So in terms of what we can use the money for, first of all, with SBA, we have to disclose our intended uses of funds. Yeah, it's kind of reasonable, right? Because we're wanting to get money from them to put into our client's business, and they want to know what's the money going to be used for. And not everything is permissible. So there, we'll just type that. Not all uses are permissible. So let's look at some examples. Probably the most common example I run into, people will come to us say, I want an SBA loan to buy an apartment complex, or I want an SBA loan to buy an office complex. Well, that's a problem because the SBA says that the real estate, and this is just one example, I'm not making a broad on all SBA loans, but for real estate related loans, the SBA wants at least 51% to be owner occupied. So let's say we bought a big office building. Could we get SBA funding for it? From that criteria, yes, if at least 51% of all that square footage is used by our business, then we could lease out the other 49%. We can't game the system. The last thing we want to do is fudge numbers on applications to get something to go through. That's considered bank fraud. So we don't want to do that. Other uses are not permissible by industry and such. So that doesn't mean the SBA is bad, but it's not open use. In contrast, ABL, there is normally no restriction of funds. So you can use it for whatever you want, and you don't have to tell them. It's your business because it's set up differently. Any questions on restricted uses? Okay. I see Brandon has a question. I'm going to come back to your question, Brandon, in a second. Let me go ahead and go through these last two comparison points. All right, now let's go to loan sizes in terms of how big of a loan. Well, there's different categories of SBA loans. There's micro loans that can go down to just a few $1,000s. There's 504, which is more for real estate and equipment. And then there's 7A loans, which are more for working capital. There's 7A Express below a certain threshold of 350,000 that has simplified underwriting. So the SBA in general can accommodate up to around 5 million. Is there a floor? The floor is going to depend upon the lender, but if we're looking at a micro loan, we might be able to go down to 5 or 10,000. Most people aren't looking for that little, but as far as the upside, we're going to tap out about 5 million. Now, when I worked at the SBA, we did a lot of funding more than 5 million. You might say, well, how does that work? That seems to contradict. Well, above 5 million, it's either owner contribution or we're bringing in a second lender, but the SBA itself has a max. But the truth is, for most of our clients, 5 million is not going to be a problem. So I don't think we run into a constraint in most cases on loan size. In contrast, ABL is just a different animal. ABL was set up for larger transactions. So I hate to put this, but I'll put it. In general, smaller is better for SBA loans. What do I mean by that? It's easier to get a smaller SBA loan than it is a bigger one because of all the underwriting. But that doesn't mean we can't get a big one if we qualify. ABL has a minimum, and we've highlighted like Chase, JP Morgan Chase, and Bank of America. They won't go below 5 million. There's quite a few others that won't go below 2 million. We do have some that'll go down to 1 million, but we'll just say 1 million, but this can vary by ABL lender. And in this case, ironically, bigger is better. The lenders like bigger ABLs. It was never designed by the finance world to be for small transactions. Well, some people come to us and say, well, I just want an ABL for 100,000. I don't think it exists. I don't think it does. It's just not meant for small deals. So that's another consideration. An SBA loan can be smaller than an ABL. Now, if the ABL is set up as a line of credit, which it can be in many cases, versus a term loan, We could get $1 million line of credit. Maybe the client only needs 300,000. Well, they could pull 300,000 from the line of credit, then they're only paying interest on that 300,000. So there's some wiggle room there with lines of credit. But in general, ABLs start at a larger amount, not because it's what you want or I want or what the clients want. It's just a reflection of the market. Any questions on the loan size comparison? Okay. I see Brian's asking a question, and it's a good one. It's not your responsibility as the distribution partner to nail down with the client where's the money going to come from. That's our role, and we do that once they're into phase 2. But just from a perspective of financial literacy, I'd like you to understand these differences, because right now we're seeing about 90% of our clients, so not all, but about 90% are doing ABL, and only about 10% are doing SBA for the reasons that we're going through. All right, so we have one more element, and then we'll open it up for general Q&A. Underwriting speed. You know, how long is it going to take to get my money? That's what everybody wants to know. Well, the answer is it depends. Well, what does it depend on? Well, we've already said that there's 2 types of underwriting with SBA. How long does it take the lender to process? And then how long does it take the SBA? We've already said that there's lots of different, well, I should say lots, there's multiple different types of SBA loans: micro, 7A, 504, express. So it varies considerably. It varies. Now, we had one SBA lender well, we have the partnership still, but that one partner was doing next day SBA loans. Now, those had to be below a certain threshold. That was remarkable, almost unbelievable, because people are like, no, that doesn't happen. But we can still do it, let's say, as soon as 7 to 14 days. But it could very well be longer because of the complexity of the deal. So that's what sometimes frustrates people when they hear from us, because a lot of answers to a lot of your questions is honestly answered. It depends. There's not always black and white answers. It depends on the circumstances. People don't like it depends, but that's the honest answer in many cases. ABL is nice because it is quick. It's, let's typically say, less than 7 days. Well, you might say, well, that doesn't make sense, Tom. If it's typically a larger amount, why wouldn't it take longer? Well, because the underwriting is simpler. There's less moving parts. They're focused on 1C, where SBA is focused on 3 Cs. All right, so then let's, okay, I see John Stockton has a point, and he's asking about, what about MCAs? So, okay, so we'll add MCAs. So those of you that are not aware of MCAs, so MCA stands for Merchant Cash Advance. Some people don't like them. They tend to be a higher cost of capital. They serve a niche. It's not our primary focus, but yes, as John's pointing out, we can facilitate MCA. And so I guess it's good to understand that one as well. So let's go ahead and add the MCA here quickly, and then we'll get to the Q&A. So what's the underwriting of MCAs based upon? Again, it's similar to ABL. It's simplified underwriting based primarily on 1C, but it's a different C. It is cash flow, specifically bank deposits. Typically, we won't get an approval for an MCA in general if we don't have at least $10,000 a month in business bank deposits. And you might say, well, that's going to be a problem because a lot of my clients don't have that. Well, a lot of your clients don't have the collateral either, but we can facilitate that legally and ethically. We can provide them the collateral if they need it. We can provide them the bank deposits if they need it. So we don't want to be of the mindset that, oh, just because the client doesn't have the attributes today, that they can't get approved in the future or the near future. That's not true. And frankly, that's what we do. You and I, what we do, we help unqualified clients become qualified legally and ethically. So there's underwriting. Let's finish John's point here. Owner contribution, it's going to be the same as ABL. Copy and paste. That'll be quicker than me typing. So MCA is similar to ABL. There's no owner contribution. Restricted use for MCAs. And again, I'm not here promoting MCAs, but it is another type of funding vehicle that's out there that we can facilitate if needed, but it's not our go-to. And for restricted use of funds, it's very similar to ABL. There is no restriction. Loan size for MCA, it's just based upon monthly, primarily based upon monthly bank deposits. But what again, and I sense the skepticism, but we can help clients get the bank deposits if that's what we're going for. We can help clients get the collateral if that's what they're going for. If they want an SBA loan, we can help them meet the underwriting criteria for it. Because again, it's like you and I are mechanics. We don't tell people just with the perfect cars to come into our mechanic shop. We help people repair broken cars. As a mechanics, as technical advisors, you and I help broken businesses. We help them legally and ethically become qualified. Otherwise, we would just be a loan broker. If we were just looking for the people that's already perfect, then that's a very competitive industry and not what we do. All right, and then lastly, underwriting speed, just to wrap up John's point, quick, often, same day or next day. So I think Mr. Stockton's got a point. It's interesting to see that there are other options other than the main two. These are the main two that we deal with, but that gives you a further side by side. All right, so let's go ahead and dig into the questions, comments, concerns that you all have in our remaining time. And again, if you need individualized assistance, recommend texting, not calling, but texting 903-347-8042. All right, so Brandon's asking, because I mentioned that the structure of an ABL can be set up as a term loan or a line of credit. And again, that's up to the individual lender if they offer both of those, but many do. And he's asking, can it be a mix of the two? Quite possibly. That's just going to be a conversation between the client and the lender once they've been approved in terms of trying to split that up. But it's possible, but there's not, it's one of those it depends answers. All right, I see Ken is bringing up a really good point. Yeah, so lines of credit are often misunderstood. So a line of credit kind of feels like a business credit card. You have a max amount, you can pull from it when you need. The rest is available later if you want it. As you pay down what you've used, then you have access to it again, unlike a term loan. Right? If you got $1 million term loan, and let's say you paid down 10%, so now your balance owes 900,000. Do you have access to that other 100,000 again? No. So that's different. Okay, I see Lamey's bringing up a really good point, and I didn't even think about it. So let's go to that. So let's talk about payback. So when we're talking about payback of these different types, let's load them up here, and then we'll compare. Sorry, phone's ringing here. Let's mute that. Asset-based lending, and then MCA. ABL is unique because we will pay the loan payments for the first 2 to 3 years. That's not applicable on the others, and I'll explain how that works. So what do we know about ABLs, asset-based lending? It's based upon collateral. Well, most clients don't have the collateral, so we transfer the collateral. When we transfer collateral, we're transferring it as accounts receivables. That counts. So with accounts receivables, they're paying a penny on the dollar to get that. So for every million of AR, they're paying 10,000. But that's not an expense. If you remember accounting 101, an expense is like going out to eat. Once you consume the food, it's gone, you have nothing left over. When they're paying 1% for that asset transfer of a million of AR, they're actually getting a million of AR. They're actually getting the asset. Well, we're licensed, bonded, and insured as a collection agency, so then we can help them collect that money. And the design of the program is to actually collect. Now, it won't last forever, but over the first 2 to 3 years on a monthly basis, the design is that we should be collecting at least as much as the loan payment. And that really helps the client out, because now the client doesn't have to necessarily worry about or even budget for the loan repayment. We're covering it through the liquidation of the AR. A little bit of advanced topic there, but I wanted to cover it because Lamy brought it up. Brandon asked about that 1%. So yes, so there's a 10% contribution for SBA related loans, 10% or more, depending upon the lender. There is none for ABL. However, we do have to qualify, right? We always have to qualify for funding. There's not some scheme to get money that we don't qualify for, not legally and ethically, so we wouldn't be involved with that. So if we wanted to MCA like John likes, then we're going to have to help them get cash flow, bank deposits, which we can do legally and ethically. If they want ABL, we're going to need to get them collateral, which we can do legally and ethically. So if they don't have the collateral, we can provide it. It's 1 cent on the dollar. And then his question is, can that be financed? Sure, yeah. So they can finance that 1%. All right. B's asking about how quick cash can play in. Sure, yeah. So quick cash is a different instrument. There's a training video that you can watch to learn more. But you're right, B, that quick cash can be used to raise capital for whatever they want. It's unrestricted. It could be used to raise the 10%. It could be used to cover the 1% of collateral for ABL and so forth. Sure, that's a valuable resource, and frankly, that's why it's there. John's asking, following up, what's the exact process for the ABL? So let's go ahead and type that here before we wrap up. So the ABL, I think we'll all come to the conclusion, the ABL is a valuable alternative. It may not be the right fit for everyone, but it is a valuable resource that a lot of people don't understand. But the process is, first, if I can hit period instead, get a free Shelf Corp. How do you do that? You either go through one of our resellers, or you can come right here to 509 Pacific. There's a training, and then right here is the grant packet. So right here, I'll highlight it. I'll lose my background there, but right here is how you get that free Shelf Corp, right there. Or you can get it from a reseller. Now I lost my notes, didn't I? So once you've done that, then what will happen is then, I don't know why my notes went away, but that's okay. Well, we really lost it now, didn't we? That's all right. So the bottom line is we will get the client plugged in for the free Shelf Corporation. And then after that, what we'll do then is we will provide the Shelf Corp in about 7 days. And then we will go into phase 2. We'll do the evaluation to see if they're a better fit for ABL or SBA or any other choice. And then at that point, we'll lock in on the funding plan with the client and then be able to follow those steps. So it always starts with having a shelf Corp to build off of. All right, well, we ran a bit long. If you need anything else, just let me know. But on 509pacific.org, and I lost my screen share. I shouldn't have navigated away from there. But nonetheless, have a great day. We'll see you back tomorrow. 903-347-8042 is our tech support line. We'll talk to you soon. Have a good day. Thanks. Bye.